Thanks for tuning in to Talking Point. I'm your host, Neeraj Shah. Back in July, UTI Mutual Fund came out with a note talking about investing in large cap isotopes. Now, it got it caught my eye simply because it's a different way of looking at uh, investing into companies which have moats, so to say. But the beauty is that their research seems to suggest that some of these large cap isotopes are actually companies that were mid cap in nature and eventually become bigger. So, the author of the note, Ankit Agarwal, joins us today to talk about what is the message that they are trying to give via this. Actually, they may not be even trying to give a message, they might just be using it for their internal investing purposes. Let's try and pick his brains about how is it that they are trying to identify these isotopes. Now, Ankit, thanks so much for joining in. Hope all is safe.
Yep, thanks a lot, and hope everything is safe at your end too.
Touch wood, all good thus far. Ankit, can we just start with the basic definition of isotopes? A lot of people might be wondering what are isotopes and how are you relating them to investing?
Yeah, so isotopes, is sort of a 10 standard concept in chemistry, where you're talking about elements which have, similar number of protons but different neutrons. So, they'll have similar chemical characteristics, but they might be different. Could be physically, or some of the physical characteristics, or the mass is actually different. And that sort of analogy you can very well bring into the investing world. And what we are trying to solve was a question that we often get in markets is with one, what is a good time to invest in mid caps, whether I should be in mid caps today or large caps. And the simple point that we are trying to make here is that it doesn't matter whether you are in large caps because or mid caps, because if you can get similar large cap like characteristics which are similar to what a large cap isotope will have in a mid cap, where they might be leaders in their own space, have great balance sheets, run by great management, and have a long track record of execution. And as long as you're invested in some of these large cap isotopes, which are mid caps, but they have large cap like characteristics. So basically, they have the chemical properties of large caps, but they are just of different mass, which is different market cap. And that's the point we were trying to make in this note, that as long as you're holding on to some of these high quality mid caps which are leaders in their own space, you will end up getting not only higher return, but sort of a similar stability that you expect from a large cap.
Okay, that's interesting. That last line that you mentioned, Ankit, which is that one that a mid cap name, which is similar to a large cap characteristic, might give you the stability that a large cap does, but in effect might actually give you better returns too. Is that a function of the fact that the size is smaller and therefore the chance of uptick is higher? Because frankly, the last 2.5 years or 3 years have shown that maybe the large caps are actually becoming even larger, both in terms of size as well as in terms of the market cap galloping that they're doing globally and maybe in India too.
Right. Yeah. So I mean, I think one of the reasons why one should invest and look at mid caps is you are looking for a longer runway of growth, and as a result, if you are early in the growth cycle, hopefully as the company compounds its earnings over a period of time, you would also compound your investment in that company. So yeah. So I mean, higher return possibility is due to some of the characteristics over a long runway that you are expecting. Also, it could be that you are operating in a sector or a niche, which today is probably very small in size, but over a period of time could become much larger. Just to bring a case in point, specialty chemicals has gotten a lot of limelight today, and if you see, most of the names in that space are made a small cap in nature. But if you're really talking about in the longer term, more of import substitution, or you're talking about global supply chains moving to shifting away from some of the countries to India, you do expect that some of these opportunities will become much larger in future. And as a result, if you are betting on some of the leaders in this space, you would end up seeing that benefit of a longer growth runway.
Interesting, and I will probe that point a bit later on, Ankit. Just a couple of things that I read from your note, which I would want you to comment on. I think your study indicates that it's the mid caps which tend to give better returns, or have tended to give better returns, at least over the last 1 year. If I'm not wrong, that's the inference that I got from one of the tables that you put out in your study. And I was also talking to Samit Vartak of Sage some time back on a note that he had written, and his study indicated that starting from 2011, um, uh, the decade has actually seen only one name, which was a large cap giving the best returns. Everything else was a mid cap, which is given best returns. So, is it that while the world believes that large is getting larger, quality mid caps should be an integral part of your portfolio and maybe having a higher weightage in the portfolio? Is that something that naturally stems as an outcome of the note that you've given?
Yeah, so I mean, definitely there is a case for investing in quality mid caps, and we have seen, and as highlighted in the note also, if you so while large caps get a lot of the limelight, what is generally missed out is a lot of your mid and small cap companies have also done really well, in the last 1 year, and if you look at the best performers in the BSE 200 index, a large part of them will be mid cap companies. And if you look at some of these companies, the common theme that sort of underlines some of these businesses is that most of them are sort of leaders in their own niche and space, and as a result, they are able to get the benefits which a typical large cap will have. So they will be leaders in that space. Availability of capital to them will be much easier. They'll have sort of very light or asset light balance sheets. So sort of unlevered balance sheets, and as a result, the stability that you see in a large cap will be there in these, and the growth that you'll see in that business or sector will help you get higher return. So it is sort of a best of both worlds, where you not only get slightly higher returns, but also you are not looking at very volatile businesses. You are looking at very stable sort of businesses, and leaders in those businesses. So yes, I mean, definitely quality mid caps make sense to have part of your portfolio.
Okay, and how does this leadership that we're talking about translate into return metrics, balance sheet benefits? I mean, are there some anecdotal evidences, or is there a common thread that if a mid cap name which doesn't have the balance sheet strength and the size at the infancy, but has these characteristics, eventually goes on to have some multiplier effects into these terms? Is there almost a 1:1 correlation of sorts? Any thoughts here?
Yeah, so I mean, I think if you look at we have done a lot of work on what are the long-term drivers of shareholder return, and a couple of factors which stand out really significantly are return on invested capital and cash flow, operating cash flows, and so we internally sort of bucket the companies into different return metrics. Companies that have pre-tax ROCs greater than 18%, 10 to 18% and below. And what we have seen is, companies which have high return on capital employed, they have very high persistency of performance, which means that 70% of companies which were, say, R1 companies, which are, companies which are 18% plus pre-tax ROCE, continue to remain R1, even, say 4 or 5 years down the line, which means that quality companies continue to remain high quality, even going ahead. Another interesting thing that we see is that companies, which were low ROCs and which tend to become higher ROCs in future, they also tend to generate significantly higher returns for shareholders. Only catch there is that proportion of such companies is very small, and as a result, you need to be very selective when you're looking at some of these businesses. So clearly, ROCE trajectory is a very key determinant of what the shareholder return will be. And we sort of look at companies in two buckets. Companies which have high return on invested capital, which will be good quality businesses but fairly recognized by the market, or companies which have lower return on invested capital but have the potential to jump into a higher orbit, thus creating possibility of a higher return.
How do you identify that? Is that a hypothesis that is built with a few assumptions, or are there some common traits that each of these companies which have a lower ROIC but potential to have higher ROIC show?
So some of these businesses could be just going through a cyclical downturn today. So for example, someone in the CV cycle, if you're heavily dependent on CV cycle, you will see some of these businesses which might be high quality in nature, but might be going through a cyclical downturn. And if you sort of identify some of these opportunities right and play the cycle right, you might sort of benefit when the cycle reverts, and you see your ROCs also improving. Second could be pretty idiosyncratic to the firm that you are investing in. So you have to be a little bit more stock specific when it comes to whether this company can move into a higher orbit. And there it could be, you could see a change in management. There's could be a change in thinking, which leads to a lot of excesses in the firm being cut down and capital being deployed more effectively. It could be that the sector might go through a structural change. So for example, what we have seen in the specialty chemical space, you could see a lot of business coming in, and as a result, the structure of the industry could change. So there is no I would say that as far as mean reversion to or mean reversion is something which you can play through the cycle. But if you want to see a structural re-rating in companies, then there you have to be a little bit more stock specific, and difficult to find a common theme when it comes to you're looking at companies moving into a different orbit.
Okay. What's the weightage? Just before I come to the themes that you might think at large might have these structural tailwinds of isotopes, what's the weightage? I'm just interested in a normal theme wherein both large caps and mid caps could have weightage. Assuming that there are no governing guidelines, would you say that you would be comfortable giving a higher than the mandated weightage to some of these isotopes which are mid cap in nature but can potentially move higher? Would you have that comfort if regulations allowed you?
Yeah, so I mean,
or what is the weightage that you're giving generally right now to mid caps, whichever, whatever?
No, so my mandate for our fund is more on the mid cap side. So it would be mid cap, small cap heavy, but in general, depending on the mandate of the fund, our sense is that you could get into a lot of these mid caps which have large cap like characteristics. If you're looking at even sort of protecting capital, or being a little bit more defensive, some of these mid caps offer a similar sort of characteristic that a large cap would offer, and you would be well served by taking exposure into some of these opportunities.
Okay, so then let me ask you, which are the spaces or themes which are looking like showing that? Because you kind of referred to specialty chemicals as one. Would you want to start off with that, and then maybe I'll ask you about some other themes as well, which are typical of what you're trying to say?
Yeah, so I mean, I think specialty chemicals, there's clearly a case for global supply chains moving to India. You are seeing a lot of traction happening there. A lot of inquiries are increasing in near term with a lot of these companies, and people are looking at China plus one sort of a strategy where you want to sort of diversify away from a very large sort of source of input for a lot of companies. So I think that benefit we are seeing in a lot of companies, and our sense is that along with the theme of import substitution playing out, you would see some of these companies benefit over the long term. I think some of the other themes.
Just before we move to the other themes, I just have a couple of follow-ups though, because I mean the hypothesis that people are laying, right? My question only is this: that the argument that a lot of people make for specialty chemicals right now is that while the building blocks and the structural tailwinds are in place, the fancy that the sector's got is so high that some of the companies' valuations have inched up quite substantially. So my question to you, therefore, is that, and again, valuation may look very expensive currently, but if it's a 10-year story, valuations may look reasonably attractive for that long-term kind of an investor. So where is it that you are on this argument? Are you believing that is it an overheated sector, or do you believe that the story is 10 years out and therefore it's okay to do the investing into specific companies even at the current valuations? Can you tell us a bit about that?
Yeah, no, sure. Clearly, I mean, in the near term, you have seen significant run up in stock prices, and valuations do look a little bit on the higher side. So the only point that I would make there is that when you're looking at companies in the mid and small cap space, you have to look at it from a sort of a longer term horizon. So you have to look at from a 4 to 5 year down the line, what could be the possible, runway for growth. And as a result, is current valuation might be on the higher side, but do they justify it, from the, with the growth that you're seeing in the sector, and what are the return characteristics that you're seeing in the companies. So I think, if you look at it from a 4 to 5 year horizon, you are still better off holding, say, a 20% growth company available to you at 20 times valuation, than maybe sort of investing in a 10% growth company, which might be available to you at a cheaper valuation. So I think as long as you're comfortable on the long term, growth runway, as long, and if it does not, the valuations don't go completely out of whack, obviously a little bit of overvaluation you might have to sort of live with, in the near term, because at the end of the day, some of these opportunities you can't really time, when you want to get in and when you want to get out. And as a result, it's always best to sort of hold on to some of these themes which are going to play out in the longer term.
So, am I understanding this correctly? You don't think that the valuations in your terms have completely gone out of whack?
Yeah, I mean, you're sort of looking at near term, the possibility that some of these companies could grow at a 20% CAGR for a foreseeable future, gives you comfort that,
Yes,
even if the valuations look expensive on a 1 year basis, but when you start looking at it from a 3 year to 5 year basis, or, when you do some sort of a reverse DCF and, what's the implied growth that you're looking at, you still, sort of, in some stock specific cases, you are still comfortable.
Got it. Okay. What are the themes aside of specialty chemicals? I think building materials is one more theme that you mentioned.
Yeah, so I think building materials again, is also, partly a play on the cyclical revival that you expect, once we see some amount of recovery happening in the economy, and also there is possibility that as more and more sector becomes organized, some of the players which are leaders in their space, will be in a better position to capture greater market share. And some of the weaker players, which in a downturn, will face, who are already facing some sort of headwinds, will continue to sort of face pressures even going ahead. They might sort of leave the sector, or might become may become difficult to survive. And as a result, you would continue to see some of these companies, consolidate their market share and even grow going ahead. Another space that we like is on the consumer space. Our sense is that consumer discretionary still has long runway of growth. And while some of the individual companies might be a bit expensive, but you would continue to see some of these opportunities play out in the longer term. I think rural is again is a theme which is sort of much talked about of late. You have seen a lot of tailwinds in that space. We believe there are opportunities in that space where there are possibilities of structural change happening, and benefit from the steps that the government is taking to push the rural economy and bring about certain structural changes in the rural sector. So I think some of those themes will continue to play out, and will benefit companies which are have large cap like characteristics, or are large cap isotopes.
Interesting. Last couple of questions, and viewers, keep in mind, standard disclaimer: none of the names mentioned out here in the chart before are individual recommendations of UTI AMC. They cannot do that. They may have bought it or might want to buy it at any point of time in the past or the future. So you got to do your own due diligence. But I just, Ankit, want to ask you a couple of questions on, one of the names in that list of which you believe could have those isotope-like characteristics is a gas utility company. And I want your thoughts on the space at large. Because while the theme looks very solid as a utility play, there are a couple of impending moves, including that open access license, etc. And there is some interest, right, with the Adani Gas Total deal. Loosely put, that's kind of in the same sphere as well. What's your sense about the kind of growth that the gas utility companies can give? And would it, I mean, because there are only 3 or 4 names, would it be, synonymous growth for almost all of them, or would they show different growth characteristics? Any thoughts there?
Yeah, so I think one important theme or recognition which has happened in India and globally is on environment. So whether it is ESG themes being pushed out globally, or people incrementally talking about environment, it's become very difficult in this world today to live, where pollution and all is sort of going up incrementally. So governments are forced to take steps to curb pollution, and that is the thing. You had rules in the past, but they weren't getting implemented in the true spirit. Our sense is that some of these environmental regulations will be put on companies, polluting industries, and incrementally you will see some of the usages of non-polluting fuels going up significantly. And that's where the play is, that structurally you could see some of these the usage of gas actually going up in the economy, and as a result some of the more less volatile place to play over there would be through the gas utility companies. I think so. Clearly, the usage of gas is expected to go up, and that is the play that we have. Where, while you are rightly said that near term there are a little bit of concerns on the regulatory front, but the long term opportunity is significant over here. That even with more competition coming in, and if you look at some of these players in the space, they have significant market share in the segments that they're present in. There is a lot of room for a lot of companies to grow. I mean, it's not necessary that everyone would want to go into, and there is still a lot of questions that need to be answered with respect to open access before companies can make their case in some of the existing geographies. But clearly, there's a lot of scope for growth in a lot of new geographies, and I think government also is pushing for more usage of gas, and pushing for more reforms. You would have imagined that some of the reforms might be getting pushed out, but we are continuing to see government pushing industries to comply with some of these norms. And even earlier, and when you would see a lot of the lobbies acting, and industry associations going and asking for sort of leniency, but I don't think any longer you'll see that happen, and as a result you would see gas usage continue to go up. So we continue to remain positive, even while cognizant of some of the risk which might be coming in the sector in the near term.
Okay, well, this was a different kind of a chat, and Ankit, I thank you for joining us today to give us a flavor in this fashion, if you will. So thank you for speaking to us today.
Thanks a lot. Thanks a lot. It was great chatting with you.
Yeah, likewise. And viewers, I hope you enjoyed this as much as I did. Think of the concept: large cap isotopes, companies which are not necessarily large cap in nature, but have characteristics which are similar, and therefore can actually give you better growth prospects as an investor compared to maybe some of the large caps. It's an interesting way to think about things. Thanks so much for tuning in today to Talking Point.